Thank, thank, thank you, Peter and Christina. We appreciate the instructions. Uh, this was this is in a way, unfortunately, well timed because the topic was set about 2 weeks ago by Peter's quarterly letter, which was basically addressing the concept not just of risk in the market and risk in portfolios, but risk in the global economy. And I don't know how many of you maybe have already read Peter's quarterly letter. Um, it's on our website for if anybody wants to look at it after this discussion. But basically, it was Peter's going to talk some at the start about the de-risking of supply chains and how companies are dealing with the risk around the world. I'm going to follow it up with a little bit of discussion on risk as it pertains to individual portfolios. But we've done this usually in a question and answer format. Usually there are two people to answer questions. Today there's just one. So I will be asking question, Peter will be answering, and then I'll be answering it, my own question. So Peter, let me start by the question that pertains to your quarterly letter. You wrote in your quarterly letter about companies de-risking their supply chains. What I thought was the most interesting part of the report was the difference between the costs, or what described as landed cost, between various countries. Can you expand on this subject and also maybe explain what the concept of landed cost means?
Sure. So landed cost means all-in cost. So that when an importer buys a product, what is included in that cost is the cost of labor, the cost of fuel, the cost of any capital expenditures made, et cetera, et cetera. So a study was done by the Boston Consulting Group back in 2022, which looked at the comparative landed costs for bringing goods and or services really into the United States, indexing the United States at 100. So that's the base cost. And we're going to compare that cost to anybody else. So what would a Chinese company cost to land goods in the United States? What about a company that operates in Mexico? What about one that operates in the Philippines? What about one that operates in Germany or Norway, et cetera, et cetera? And so using the United States, because this is the biggest market in the world, as the basic cost, that was indexed at 100. And to give you some comparative numbers, in Europe, Sweden was indexed at 105, so it was about 5% more expensive to deliver a good in the United States, whereas Norway was indexed at 122, i.e. 22% more expensive. Now, in Southeast Asia, the Philippines was indexed at 79, so a good bit less expensive. In Vietnam was indexed at 84, and in India was indexed at 85. Interestingly enough, the go-to place for manufacturing goods imported into this country for years has been China. China was indexed at 121, and primarily that's because of tariffs that were imposed upon China during the Trump administration. Ex those tariffs, in 2022, China would have been indexed at 96, less expensive than the United States, but more expensive than Mexico at 84, or India at 85, or the Philippines at 79. And the primary reason for that is because of labor costs. Labor costs in many of those countries that I just mentioned are a lot less now than they are in China. China was for years a very cheap labor cost manufacturing country, but that's no longer the case. As years have gone on, Chinese wages have increased quite a bit. Now, they're still a lot less than they are or they are less than they are in this country, and they're a lot less than they are in Europe, but they've gone up rather dramatically. So the conundrum that a lot of businesses had coming out of the pandemic was that China, while it had gone up in cost, was still favored as a manufacturing site because there was tremendous infrastructure that had been established over the decades since the 1980s, when China really opened up to the capitalist way, as I say. Well, coming out of the pandemic and China had shut down, supply lines got very clogged up. And as a consequence, that clogging up, if you will, sand in the gears, raised expenses around the world because people were not able to get goods as quickly as they wanted to get them in their stores. And so industrialists decided that what they had to do, they concentrated too much of their production processes in China. And this presented a risk. And so they decided that they had to diversify their supply lines so that they could supply their customers, wherever they be, with goods when the customers wanted them. And this started the search for other places, other locales to produce goods. Many manufacturers started going to places like Vietnam, Philippines, and now a growing favorite is India. So now we've got a more robust logistics supply chain, as opposed to one which is largely concentrated in China. We're not entirely out of China, and I don't think any major company that produces in China wants to rid themselves of Chinese production, because a lot of companies want to produce for the very large Chinese market. There are over 1 billion people in China, and that's quite a handsome market. So they're going to maintain manufacturing capacity in China primarily to produce for the Chinese market, but they're going to diversify their logistics to other countries like the Philippines, like India, like Vietnam, where costs are lower, all-in costs are lower, so that they're not beholden to one manufacturing horizon, and thus increasing the risk of delivery of goods to their customers in the United States if something goes wrong in China. So, Richard, do you have any further thoughts on that?
Well, I was just going to mention two other concepts that relate to what Peter was talking about, and some of you may have heard these terms. There's the term reshoring, which means taking supply lines that had been remote, perhaps in China or perhaps in other parts of the world that the labor was cheap or the distribution costs were low, and moving them back into this country, reshoring them or bringing them back on U.S. soil. And that's obviously a fairly lengthy and a fairly expensive transaction, but once it's on shore, you've pretty much reduced the risk of distant supply chains. There's the concept also of nearshoring, which you might have also heard, and I think that's used not exclusively, but a lot with manufacturing that's been re-designated in Mexico. Mexico is obviously part of North America. It's close to a lot of major US markets. It reduces the risk of transportation. It reduces some of the risk. It adds a little bit of risk relating to political instability, maybe some social instability. So it overcoming the fact that goods can be landed, quote unquote, 16% cheaper from Mexico than they are in the US, but it comes with some additional risk. So again, de-risk often means risk reduction. you're never taking the risk completely out of the equation, but you are certainly affecting the aggregate cost of that decision.
Let me go ahead.
I was going to make one other point that Taiwan Semiconductor has recently been in the process of building a fab factory, a fabrication plant in Arizona. And this is part of de-risking their supply chain to service their major markets, which is North American markets. And they've run into an unexpected problem, and the fact that there's not sufficient qualified labor to operate the plant. They can get the same exact machines and everything in place, but they don't have the labor, and they don't have the support industry around the plant that exists in Taiwan. So sometimes nearshoring and reshoring and offshoring have unanticipated problems and sometimes some collateral damage as well. Sorry to interrupt you, Peter.
No. Those are very good points. And I'd just like to add one other. We in this country have become very used to the extreme cost competitiveness of Chinese production and have worried that all this nearshoring, reshoring, other shoring, if you will, was going to add a lot to cost and inflation worries. Well, as BCG, Boston Consulting Group, demonstrated, there are other places that are less expensive to produce than China is today. But no doubt, in just making the transition from China to India or from China to the Philippines, and without the infrastructure that the manufacturers built up in China over years, and having to reestablish some of those other supply lines to supply their own factories in new places, there will be some increased cost on a transitional basis. Once the supply lines, the logistics become very smooth another time, then costs will go back down again. But it will be a much more resilient logistics system because it will be well diversified among a number of different countries. It will not be so concentrated, and as a consequence, the risk will be a hell of a lot less.
And one last thought on this topic is it has some meanings for individuals' portfolio, because as logistics support and manufacturing and assembly plants are moved out of China into some of these other peripheral nations or back to Mexico or even Canada, there are investment opportunities in those countries. It's not a coincidence that the major market that's down the most this year is China. And some of the Asian markets have had some pretty robust performance. Even Japan, which has been, 20 years in recovery mode, has shown a great deal of robust returns so far this year. So the deck is being reshuffled as we speak.
Yes.
So back to your letter, Peter. You had mentioned that the U.S. economic engine is running as usual and that there seems to be no recession in sight. Can you speculate, therefore, on why so many of us are uneasy about what's going on with the economy?
I can certainly speculate. I'm not sure I'm going to deliver a definitive answer, but I think people sometimes forget some things that have gone on over the last couple of years. 401ks are up pretty nicely. The value of people's houses are up nicely. Unemployment is very low. Incomes, wages are up quite sharply as compared to the past. So there are a lot of good things that have gone on, and the consumer's balance sheet is very strong. In fact, there was a study that just came out of the government yesterday, which suggests that consumers' savings, which the government thought was about to run out. Remember, during the pandemic, the government opened up its purse strings to help support a lot of people, a lot of small businesses, and wrote checks and directly to those small businesses so they could retain employees, et cetera, et cetera. And people's savings went up dramatically as a result of those checks coming from the government. Well, those checks stopped, and people have been working off their savings and spending down that bank account, if you will. And there were various estimates by various pundits that would have clearly suggested that we were about to run out of that money. That money was pretty well spent, and now the American consumer is going to have to depend upon their own credit card, and as a consequence, could be a little bit more shy about spending. Well, a study came out yesterday from the government that said, oops, we made a mistake. Actually, there's a lot more in savings for the consumer. In fact, there's in excess of $1 trillion in the consumer's bank account that upon recalculation, we've discovered that is still available for expenditure. So the consumer's balance sheet is in good shape. People are employed. People are earning good wages. The value of the 401ks are up. Housing values are up. But yet, as you said, Richard, people still feel a little bit uneasy. I can only speculate it's because, number one, there's still some lingering fear about inflation, despite the fact that inflation is down mightily. The CPI topped out at over 9% last year, and now we're down around 4%. So the CPI has come off mightily. But also recently, there was a study done by the New York Fed, which says that consumers, small businesses and consumers, are feeling uneasy not only because of lingering inflation fears, but also because of interest rates going up and perhaps credit getting tight. And so people are, trying to go out, consumers are trying to go out and maybe get a loan or something of that nature. Number one, they're shocked by the interest rate that they might have to pay. And I guess there's some pushback on the part of banks saying that, oh, well, we've tightened our credit standards and we might have lent to you a couple of years ago, but we're not so enthusiastic about lending to you today. So I think this is, led to some unease too. So lingering inflation and also credit being more difficult to get.
Let me add some thoughts to that as well. I think we came out of the pandemic, a lot of us either unhappy or almost angry. And clearly the constant drumbeat that we get from our cable news networks keeps us a little bit uneasy on both sides of the spectrum. The 60% of the people that are probably in the middle are not likely the ones that are answering the telephones of the pollsters, calling them to ask if they're happy or not. So there may be a little bit of a bias in all those polls, but nevertheless, I think people are, for the most part, a little bit less than enthusiastic and optimistic about the future.
Well, certainly the news that we keep hearing on a daily basis is not happy. So until we start getting a more constant drumbeat of better news, whatever that news might be, it tends to influence people's feelings, their sentiments. And certainly we've seen that with consumer sentiment. Consumer sentiment is not where it used to be. It is down. And analysts have been scratching their heads about this because, again, people are employed, wages are going up, people have got savings, they're spending money. The American consumer has continued to be incredibly strong with regard to spending money. We see it in retail sales numbers, we see it in restaurant numbers. So money is getting spent. The economy is moving ahead, and yet people just have this sort of uneasy feeling in their craw, and nobody can really put their finger on it.
It might have something to do with the fact that there's been a war on in Eastern Europe for the last 15 months.
Sure.
And then, of course, the last weekend didn't help the situation at all.
Yeah.
I think a lot of people are just concerned about the general level of unease around the world.
Yes, I agree. I agree.
We'll get back to the implications of that for portfolios in our next question. If you don't mind, if I go ahead, Peter, this Zoom call is entitled De-risking, New Risks and New Rules. Let me distinguish between de-risk and risk management. De-risk generally means to attempt to remove risk altogether from a situation, or at least dramatically reduce risk. Most of the portfolio management tools manage risk without de-risking. And the typical things that people do to manage risk are shortening the maturities on their bond portfolio, or maybe switching from growth stocks to value stocks, maybe reducing the percentage in equities, things like that. That manages risk. De-risk would be something like taking money out of your investment portfolio and putting it in a portfolio of CDs, maybe buying land in the neighboring town that's experiencing somewhat of a boom would be a way to de-risk your assets. With that in mind, Peter, can you discuss what risks are out there that we haven't mentioned yet today?
Well, we haven't so far gone into a great deal of depth about geopolitical risk, and this is obviously very timely with what happened over the past weekend. It is in this particular instance with the incursion of Hamas into Israel. At the moment, the markets seem to be fairly relaxed about this particular geopolitical risk. If we were in the 1970s, the markets would not have been relaxed, and they weren't relaxed then. So when the Yom Kippur War occurred and the Arab states sort of locked arms, if you will, and decided to reduce the flow of oil to Western nations, all of a sudden the world was on edge. Today, we're not in that sort of a situation at all. In fact, the oil markets have traded lower. Oil is trading about $83 a barrel right now. That's down from over $90 a barrel about a week ago or 10 days ago, when there were a number of analysts on the street, and this was before Hamas had gone into Israel, when analysts on the street were suggesting that physical supplies of oil were too tight, demand was going up, and oil was going to go over $100 a barrel. That didn't happen. It started going south, if you will, and now we have a war going on in the Middle East, and the price of oil is still going lower. The primary reason for that, or why I think the markets are so relaxed at this juncture, is because there are 4 million barrels of production, daily production, which have been taken off the market in the last year. Those barrels are held by Saudi Arabia and the United Arab Emirates, and those would be considered countries that are friendly or near friendly to the United States and to the West. So I think the market is sitting there saying right at the moment that as long as this particular instance, if you will, is localized to the Gaza Strip, to Israel, and goes no further, then the oil markets are not going to be too worried about it. Saudi Arabia came out very quickly and said that they were not going to do anything but balance the markets. They were not going to allow politics to enter the equation. Now, that's a very different declaration than they made back in the 70s, when they obviously allowed politics to enter the production equation. But they said they're not going to do that now. The United States has quite demonstrably outlined their position. We have sent the Gerald Ford and its battle fleet to the Eastern Mediterranean to dissuade any bad actors from moving any further to take advantage of the situation. And the last that I read, the new chairman of the Joint Chiefs of Staff has announced that he sees nothing to suggest that any other party is really getting involved at this juncture in this fight between Israel and Hamas. So that is certainly a geopolitical risk. Another geopolitical risk, which this country has been facing now for about 5 or 6 years, has been China. China has certainly taken a political turn for the worse, if you will. It has gone from being a very strong capitalist rotor, if you will, to now again allowing communist politics getting involved in business decisions as a result of a number of moves that China has made over the years. The Trump administration decided to slap some tariffs on a lot of imported goods out of China. And under the Biden administration, those tariffs have been maintained. In fact, in certain instances, in certain technologies, the tariffs have been amped up. And so as a consequence, there are some people, some advisors, some investors in the world who have, over the last year or so, described China as uninvestable. And so as a consequence, and we're seeing it in the markets this year, the Chinese market, as Richard earlier mentioned, is one of the worst performing markets in the world. There's been a lot of capital, primarily US capital, which has been withdrawn from the Chinese markets because a lot of people have determined it to be uninvestable. The rules change too quickly. There have been instances where executives have been kidnapped in Beijing or Shanghai. And so I was talking to a friend who has a major office in Beijing, has got a couple of other offices in Shanghai and Guangzhou. And he was over there. The company was celebrating its 50th anniversary of doing business in China. And he said the streets were absolutely bare of Americans. He said, couldn't find an American wandering around the streets. He said he saw a few Europeans, a few Brits, but he said no Americans were wandering around. So that's obviously a geopolitical risk which continues. Late last year, we had one of these Zoom calls, and we had as a guest speaker the former ambassador to Taiwan, who we would call our ambassador to Taiwan. We're officially not allowed to call him an ambassador because that would ruffle too many feathers. But we had the former ambassador to Taiwan, and he discussed at length the possibility of China, mainland China, invading Taiwan. And this is what is uppermost in a lot of investors' minds, because if that were to happen, the world's semiconductor choke point is the manufacturers of semiconductors in Taiwan. And so if Taiwan were to get embroiled in some sort of conflict with mainland China, that would be very harmful not only to their own economies, but to the world economy. So, luckily, when one has a well-diversified portfolio of liquid portfolio assets, one can buy and sell at a moment's notice. And liquidity is only a day, maybe 2 days, maybe 3 days away. It's very different when you've got a plant that's situated in mainland China or in Taiwan or in Israel right now, where you might be concerned that you've got a lot of money, you've got a lot of assets tied up in that particular operation, and how am I going to get away from this? When you have a portfolio of stocks or bonds in these various countries around the world, you can react much more quickly to this geopolitical risk. And there are obviously various gradations of geopolitical risks. There are places where no, you don't want to go at all. You just stay away. That's de-risking. You just stay away from it. And then there are other places where, well, maybe it was at one time highly favored, but now it's come down the totem pole, if you will, and maybe you're changing your mind. And that could be a good representative of that. Could be China, where people used to have 20% of their international equities tied up in China because the future looks so bright. But now you may well have only around 8%. I think the weighting in the MSCI World Index is now around 8% for China. That's quite a move. Whereas now people are moving their capital to a place like India. So that's gone up as far as being a favorite place for investors. They're moving a lot of money into India, and India has gone from like around 8% to about 12% in the MSCI Capital Index.
At Baldwin, there are a number of investment research pieces that are circulated among the investment professionals there. And there was a piece sent out today. I think our CEO sent out a piece from Howard Marks. And some of you may have heard of Howard Marks, some may not have, but I consider him one of the smartest investors this side of Lincoln, Nebraska, and with obvious reference to Warren Buffett. Howard Marks, who has been in the business of managing bonds his entire life, although he was an equity guy for a while, has said that what's happened in the last year or two represents a sea change. And he is suggesting, I don't know if this is absolutely seriously or just sort of rhetorically, but he's suggesting that his clients sell all their stocks, sell all their bonds, and all their real estate, put everything in high yield bonds. Of course, that's his asset class. So, it's a little self-serving. But as he said, the yields on high yield bonds, the current yield has gone from about 4% 18 months ago to over 8% now. So he figures even if there's defaults in there, he's still going to get a 6 to 8% return on his capital. Peter, how do you view some sort of radical reallocation like that, even if you thought it was a sea change? Is that a little too dramatic for you?
Way too dramatic for me. I've never been an investor that would make such a dramatic change, because I've never been faced with anything that at least I thought was so serious that I would divorce myself from the equity markets, if you will. I always think it a huge risk that an investor takes when an investor basically bets against the American economy and bets against American capitalism. The markets in this country have a history of going up about 70% of the time. So that's the house bet. And I've never thought it a good strategy to bet against the house. We're not going to go up every year. We're not going to go up every quarter. There may be a couple of years when we're not going to go up. But to say that, I'm just going to get out of US equities would be way too radical for me, because I think there's still too bright a future with regard to corporate wealth and health that I want to be a part of. I don't want to get out of all that is two decisions, two very important decisions. Number one, to liquidate everything and to pay the taxes on that, because that's lost money unless all your investments are in some sort of retirement account or something of that nature. But if you're a private investor, to pay a huge capital gains tax, that's lost money. You're gonna have to work to get that capital back. And then you've got to make the right decision to get back in. And for people that have made the decision to get out, it must have been something really earth-shaking for them to say, I got to get out of this thing. And the best time to get back in is when there's even more blood on the streets, as Baron Rothschild would say. You invest when there's blood in the streets, and and that's always that's even a more difficult time to get back in, because human nature would say, oh, I can't possibly want to get involved in this. I mean, corporations are going belly up, people are jumping out of windows. I'm not doing this, and so you miss the opportunity of the rebound and the markets going back up. So I may want to fine tune my portfolio. I might want to, because I am concerned about a couple of big issues. I may want to reduce my exposure to the markets and keep some dry powder, but I would never ever get all the way out of the markets.
Gary and I met the other day with a client who was describing the de-risking that his son had done to his portfolio. And I just wanted to pass this example along to our participants in here today. He was taking about between 10 and 15% of his investment portfolio and building a gigantic house down near Kiowa Island, South Carolina. Way more house than he would ever need. Like 7 bedrooms with 5 baths and a huge kitchen and decks and porches. And we were asking if he would ever retire there, building this huge house. No, he wasn't building it all for him and his wife, although they planned to use it. He was building it for the golf buddies that were going to come down, play the golf course at Kiowa, rent the house, have their fine week down at the place. So it's an income producing property. It's de-risking his investment portfolio. And maybe you could argue he's taking some risk over there. But I thought that was a really good example of a de-risk strategy, as opposed to a risk management strategy. Any comment, Peter?
I guess I would say it's more risk management, because he's still got equity. He's swapping one form of equity for another form of equity. He's de-risking, if you will, or managing risk out of the stock market. But I can tell you, sitting on the board of a property casualty insurance company, when you build a big house on the coast, either coast, East Coast or West Coast, with all the catastrophes that we've had and all the catastrophic losses that these property and casualty insurance companies had this year, with whatever hurricane or whatever fire comes through your neighborhood, I think all you do is swapping one risk for another, and I don't know which is the lesser risk.
Point well taken.
Yeah.
We've lasted a little bit beyond what we had planned to do, so we want to still have some time for questions. Chrissy, you want to poll our participants and see if there are any questions or if they send any in through chat?
Yeah, let me just take a look here. I have one question. Payroll numbers recently announced were huge. Is this good or bad?
You want me to take that, Richard? You want to take
Yes, please.
it? Well, I would put it in the camp of that's good news. Everybody likes to be employed. And I do not subscribe to the philosophy that because we are fully employed, that necessarily leads to higher inflation. And that's what the people who would say good news is bad news would argue. So the markets initially went down on that news last week because the markets were saying, well, more people employed necessarily leads to higher inflation. What they didn't see in the report, however, was that wage growth actually grew less fast than what was expected by the market. It did grow. Wages didn't go down, but they grew less fast than what the experts were expecting. And thus they said, well, that's good news because it's another indicator that we're getting down to that 2% inflation that the Fed wants us to get to. So I thought it was good news. The markets turned around in the morning. The markets determined it was good news, and we had a nice strong day on Friday.
And I agree. It's obviously good news when people get jobs as opposed to losing jobs. It does probably maybe have the argument that it might prolong the higher for longer argument. But, I think the Fed's going to do what the Fed's going to do. So let's celebrate it for those new jobs that all those 226,000 people have.
Mm-hmm.
And just a reminder, everybody, if you want to raise your hand and put yourself in a queue to verbally ask a question, you can just hit that reactions button on the bottom of your screen and hit the raise hand, or hit *9 if you're dialed in on the phone. I do have another question in the chat. It says, I'm wondering why alternatives are just bonds. What about preferred stocks or dividend stocks with high yields?
You take that one, Richard.
Okay. We've liked preferred stocks at many times in the past. We've been disappointed sometimes in the performance. We're not disappointed in the income because the income tends to be higher. They're also preferred, so therefore they're paid before the common shareholders are paid. So it gives a level of protection. Often the market looks at preferred stocks as bond substitutes, and traditionally the world looked at two types of assets in the financial markets, bonds and stocks. But the market's become a lot more sophisticated. At Arcam, we look at 4 asset classes: U.S. stocks, global stocks, income investments, and alternative investments. And among alternative, what we include is energy, infrastructure, real estate, any kind of commodities or currencies, as well as nowadays there's some former hedge fund strategies that are available in either ETF or mutual fund format that we've included in portfolios. Again, diversification is reduction of risk without reducing the expected return.
And we would agree that alternatives have a real part in most people's portfolios. They used to be considered exotic. And I think that adjective has now sort of been stripped away from alternative investments. I can tell you with regard to major pension plans or endowments, alternative investments, especially within the private world, have grown dramatically in popularity. It's no longer like a 2% allocation to alternatives. Alternatives could now occupy up to 25-30% of a large pension plan or endowment portfolio. So I think as more study has been done The academics have come along with the practitioners who led the band with regard to, there's a broader market out there than just the age-old portfolio of some stocks and some bonds, and now you're diversified. There are other ways to diversify prudently to maximize the return and dampen the risk of a portfolio.
And I have another question here. Is the 2% inflation rate the Fed manages for realistic, or should a higher rate become the new normal given the current economic conditions?
I'll take that first because I almost mentioned that about 5 minutes ago. I hope the Fed embraces something between 2% and 3%. And if you think of it, 3% is 50% higher than 2%. So it's hard to think that it's going to be easy for them to accept a target that's 50% above their current target. But even if we went 25% above their current target at 2.5%, I think the market would be very relieved, because that means the Fed can start reducing rates sooner.
I would agree with Richard, subject to market pressures and circumstances. So if we continue to go along as we're going right now, I believe we're going to get to that 2% target. And I'm not sure that it's going to be as hard as some writers would suggest. We've already had a very dramatic drop in inflation rates for a whole host of reasons. Some have to do with what we were talking about at the very beginning of this discussion, i.e. supply logistics. What was a mess a couple of years ago has now gotten cleaned up and is running much more smoothly. And as a consequence of it running much more smoothly, prices have come down. If there are pressures out there in the marketplace, and I'll outline one pressure, and that's interest to be paid on government debt. So as I'm sure you all are well aware, this country has run some pretty significant deficits now for quite a period of time. And as a consequence, we've run up quite a tab. We've got quite a debt on our balance sheet. In fact, getting back to what we were earlier talking about, if you take a look at balance sheets, corporate balance sheets are in very good shape. Consumer balance sheets are in very good shape. Most local state governments' balance sheets are in very good shape because they have to run balanced budgets by law. The one balance sheet that's in terrible shape is the federal balance sheet. Now, when we were paying zero on treasuries, it really didn't matter what the deficits were because, we weren't paying any interest on that. But as interest rates have gone up, that is now taking an increasing and a significantly increasing part of the federal budget. And it's beginning to hurt. So where I think the Fed might sort of not get to the 2% and might be satisfied with the ballpark, we're at 2, 2.25, 2.5, and I'm okay with that, is if there's enough political pressure put on saying we cannot afford to pay 5, 6% coupons on treasuries. So the Fed has got to start lowering interest rates. Now, we hope that the market and the bond vigilantes will not come out and they'll sit there and say, yeah, we think you've done a good enough job. But that sort of pressure exerted by the market on the one hand, i.e. the government paying 6% coupons on treasury debt, which they can't do, forcing the Fed to lower interest rates, would be an instance where I could see where we could sort of get to the neighborhood, but not quite achieve 2%.
Peter, I agree with everything you just said, but I'm worried if they try to take it all the way down to 2%, they may just take it right down to 1.5%. And once it starts slipping and falling below that, they're going to be pushing on the string, trying to get the economy to kick in again.
Yeah.
And that's the only thing worse than inflation is deflation.
Absolutely. And that's what this country was worried about for about 10 years. We had extraordinarily low inflation, and many experts would argue that it was disinflation and we were fighting deflation. And the Fed's not geared to fight deflation. We had a bad experience with that during the Great Depression. And what pulled this country out of the Great Depression was World War II. The government just got in and said, we're buying everything. And we need to buy everything because we're about to go into this war. But having that sort of an excuse, the Fed doesn't know how to handle, and that's why it was scared to death of allowing us to get into deflation. Because when you get into deflation, everybody steps back and everybody says, well, I'll wait till next Tuesday. It'll be cheaper next Tuesday. And then it's next Wednesday. It'll be cheaper then. And then nobody buys anything. And then it just continues to spiral down. So I agree with you, Richard. We don't want that. I don't think the Fed wants that either.
So the next question is, right now, do you consider the stock market to be cheap or expensive?
What do you think, Richard?
I think it's neither. I think it's priced about right. It clearly psychologically could go either way. Having a prolonged war in the Middle East might negatively impact psychology, but I think the price earnings ratio is just about at the right place right now.
I would agree. I think what has surprised a lot of analysts on the street is exactly how vibrant the U.S. economy is, how well managed corporate America has been. The street has been constantly surprised on the upside with regard to earnings, cash flows, and dividend payments. And as a consequence, we believe that the last quarter was a trough in earnings, and that this third quarter earnings season, which we're about to get into, is going to show an uptick, and the fourth quarter will be even stronger. And then next year, analysts are predicting a 12% increase in earnings. And for 2025, they're expecting another 12% increase in earnings. So again, this economy, I would contend, is going along very nicely. And companies have been able to manage around a pandemic. They've been able to manage around a real supply logistics problem when China shut down, and come out on the other end, all the while maintaining their margins. Margins have gone down a little bit, but I think we entered the pandemic with margins at about 13%. And we're down to about now, I think it's 11.5%. And people were expecting us to return, or corporate America to return to the mean, which is more like around 9%. And we haven't done it. And that's a testament to the management teams. They've been able to manage their way through a lot of disruption to maintain profit margins. And now we're looking at sales beginning to ramp up.
It's almost 5 o'clock. I think we're probably overstaying our welcome and everybody's home. or office. So is there anything you want to conclude with, Peter, before we ask Chrissy to shut us down?
No, but to thank everybody very much for coming, attending, asking questions. We appreciate it a great deal. We would very much enjoy your feedback, what you liked, what you didn't like. We always learn from that feedback. I was taught very early on, I gotta face the camera. I can't be looking away. So I did, hopefully I've learned and I've done a little bit better job with regard to that. But we enjoy all your comments and questions, and please don't hesitate to contact us if, after we're all done this, if you've got any more questions, we're happy to answer any of them at any time. And this has been recorded,
Yes.
and so it will be up on our website, so you'll be able to, if you want to catch an answer again or something like that, you can review that. So, Richard, any final thoughts from you?
No, just thank you, Peter, for participating. We do this every quarter, and the topic is picked from our learned chairman's letter that he does about 3 or 4 days before the beginning of the new quarter. So we will have one in early January with something that's topical from December. Thank you for joining us today.
Thank you. Take care. Go Phillies.